what we're in right now is probably a 3 to 4 to 5 month period where markets are going to struggle, but most likely most of the downside for this current corrective process is likely in. This is what you need to know before the bell this morning. A couple of headlines out this morning. First of all, markets are open a little bit weaker this morning. Tariffs have not gone away. And over last night, Nvidia came out. They said, hey, we're going to have to take about a $5 billion charge on the G20, which is their kind of their stripped down version of their AI chip that they can ship overseas because of the ban on those chips. There's now going to be basically a export tax on those chips. So again, Nvidia's going to have to take the charge for that. So that's going to weigh on Nvidia stock this morning. But Nvidia's been doing well lately. It's actually been outperforming the market for the most part. So again, a little bit of a pullback here. It's really just not surprising, and particularly that we're still getting a lot of this tariff news that's going to keep coming through. The bigger headline that you're going to see a lot today and over the next really kind of few days, and particularly like over the weekend, I'm sure you're going to see a lot of headline and commentary about the death cross, which is this 50-day crossing below the 200-day. Yes, it's concerning for a couple of reasons. One, it provides a more aggressive overhead resistance for stock prices. So as stock prices try to recover back to this level, that 50-day moving average is going to provide pressure, downward pressure on asset prices here near term. And then you got right above that, you got the 200-day. So normally when stocks are trading below the 50 and the 200-day and you do get a cross, as this is happening now, that just means that basically you're in a consolidation or a corrective period in the markets. Now, again, when you start hearing terms like death cross, immediately people assume, oh, we're going back to the next financial crisis. No, that's not the case. We can go back in history and you know, again, there's two types of bear markets or corrective markets, I should say, be more fair. You have event-driven corrections, which is what we're in the middle of now, right? So we have tariffs. They were tariffs on. Now they're tariffs off. It might be tariffs on. We don't know, but you have an event, and eventually that event is going to get priced in by the markets. Markets are going to price in tariffs, they're going to reassign valuations, those type of things. So event-driven corrections, like we're in now, tend to last about 3 months altogether. And then markets recover, start to move back higher again. Credit, or what we call more kind of constructive bear markets, which are markets that are driven by a really kind of a credit-related event. Think, dot-com crisis, you had companies blowing up because of accounting issues, Enron, WorldCom, et cetera. Financial crisis, you had, the whole subprime, kind of credit-related meltdown in the markets. Those tend to last longer. Those are 12 to 18 months. Right? So again, what we're in right now is probably a 3 to 4 to 5 month period where markets are going to struggle, but most likely most of the downside for this current corrective process is likely in. We're likely going to be starting to form bases through here. So again, it doesn't mean you're not going to get another pullback here, potentially a retest of lows. Don't be surprised with that at all, and particularly with this kind of declining, resistance that we've got at the moment. We've got the 50-day pointing lower, you've got the 20-day pointing lower. That's going to continue to put downward pressure on prices. Every time markets rally back towards these resistance levels, as we are right now, right? We rallied off last week, came back up this 20-day moving average. We're struggling with that right now. Market's going to be down a little bit this morning. We're looking at Dow being down about 41 points here at the open. So markets have been struggling here for the last few days, in particular right around this 20-day moving average. You have the same problem when you get up to the 50-day moving average. So that's going to continue to kind of keep us in this kind of sideways grind process probably for the next 2-3 months. And so it's going to be a little bit of a disappointing market. The kind of this, every day you come in, the market's up 1% a day or whatever. That's probably behind us for a while. Early this year, we said that markets were going to, if we talk about curb your enthusiasm, markets are going to be more volatile this year, probably not make a lot of money this year. That's certainly been the case so far, and it's likely going to be that way here for a while because we are in an event-driven correction. We're not through that event yet. And markets still have to digest what all this means for stock prices and forward earnings. Those are starting to come in line, but more work to do there. A few things to get into this morning. I touched on just a second here and before the bell. Brent needed an out for that. And that's what you need to know before the bell. There you go. I didn't give him an out on that one. So.
What, you didn't like that one?
Different background.